Here's a question I get all the time. If my fixed index annuity is linked to the stock market, why don't I just invest in the market myself? It's a fair question. And the answer is this: your principal is protected because you're not invested in the market at all. Not $1 of your premium ever touches the S&P 500 or any other index. So, if that's true, how does the interest actually show up in your account? That's exactly what we're covering today. No jargon, just a clear explanation of how crediting actually works inside a fixed index annuity, so that you can walk away knowing exactly what you're looking at the next time someone shows you a contract. Let me tell you about a client I'll call Carol. Carol is 63, and a few years ago she moved a portion of her IRA into a fixed index annuity. Her reasoning was simple. She had lived through 2008, she had lived through 2022, and she was done watching her retirement savings drop 20-30% in a bad year. But Carol didn't want to give up on growth entirely either. She wanted her money to have a chance to grow. That tension, safety on one side, growth on the other, is exactly what crediting methods are designed to balance. So let's break down how that balance actually works, starting with where the money really goes. When you put your premium into a fixed index annuity, or FIA, here's what actually happens behind the scenes. The insurance company takes the bulk of that premium and puts it into what's called their general account. This is largely invested conservatively, primarily in bonds. This is what allows the insurance company to guarantee your principal. Then, a smaller portion of the expected earnings is used to purchase financial instruments called options, which are tied to the performance of a stock market index. Now, I want to be careful here because this part often gets oversimplified. You're not buying options. You do not own options. This is simply the mechanism the insurance company uses to internally be able to offer you index-linked growth potential without exposing your principal to index losses. That's the foundation. Bonds protect your principal. Options are the tool that allows for index-linked upside. Let's talk about the index itself. Most fixed index annuities use the S&P 500 as the benchmark, though many now offer other index options as well. Here's the key thing to understand. You never own the index. You never receive dividends from the index. And you're never exposed to a loss in the index. The index is simply a measuring stick. Each year, the insurance company looks at how that index performed and uses a formula called a crediting method to determine how much interest to add to your account. Now let's talk about the three most common crediting methods you'll see in the marketplace. Method 1. Annual point-to-point with a cap. This is the most common method. The insurance company compares the index value on day 1 of your contract year to the index value on the last day of that contract year. Whatever percentage the index went up, you get credited that percentage up to a cap. Let me introduce you to David. David's contract has a 6% cap. This past contract year, the index was up 9%. Does David get 9%? No. David is credited the cap, 6%, because that's the maximum his contract allows. Now, here's the part people love. What if the index goes down? If the index drops 9%, David isn't credited negative 9%. He's credited 0. Not a loss, 0. Method 2. Participation rate. Instead of a cap, some contracts use a participation rate. That means you participate in a percentage of whatever the index gain is, with no fixed cap on the upside. Let's look at Linda. Linda's contract has a 50% participation rate. If the index goes up 10%, Linda doesn't get 10%, she gets 50% of that gain, which is 5%. If the index has an exceptionally strong year, say up 20%, Linda will be credited 10%, half of that gain. The upside isn't capped at a specific number, but it's scaled down by that percentage. Method 3. Spread, sometimes called margin. With a spread, the insurance company subtracts a set percentage from whatever the index gain is, and you keep the rest. Here's Sandra. Sandra's contract had a 2% spread. If the index goes up 9%, we subtract the 2% spread and Sandra is credited 7%. But here's an important detail with the spread method. If the index only goes up 1% and the spread is 2%, Sandra is not credited a negative 1%. She's simply credited 0. The spread can reduce your gain, but it never pushes you into negative territory. Some contracts today actually blend these methods together or offer you multiple index and crediting strategy choices within a single contract, so you can diversify how your growth potential is calculated. I want you to notice something that's true across every single one of these three methods. In a down year for the index, you're credited 0, not a loss. This is one of the most powerful features of a fixed index annuity and is often one of the most overlooked. Let's go back to Carol. In one particular year, the index she was linked to dropped 18%. Carol's account didn't drop 18%. It didn't drop at all. She was simply credited 0 for that year, and her principal, plus any interest she'd already earned in prior years, remained fully intact. For a retiree who may also be taking income from this account, avoiding a loss in a down market year can make an enormous difference over the life of a retirement plan. This ties directly into something called sequence of returns risk, which we covered in a previous video, and I'd encourage you to check out if you haven't already. So, which crediting method is right for you? Honestly, that depends. It depends on your specific goals, your time horizon, and how the actual rates compare across different companies and products, because caps, participation rates, and spreads vary quite a bit from carrier to carrier. This isn't a one-size-fits-all decision, and it really shouldn't be made from a YouTube video alone. It should be based on your specific numbers. Before we wrap up, I want to be very clear about a few things a fixed index annuity is not. It's not a variable annuity. Your money is not directly invested in the market, and there's no prospectus involved. It's not a security. It's an insurance product, regulated as such, and is not FDIC insured. And it's not free. The trade-off for that principal protection is a deliberately limited upside through the cap, participation rate, or spread we just walked through. Understanding this trade-off, safety in exchange for limited growth, is really the heart of deciding whether a fixed index annuity fits into your retirement plan. Let's recap quickly. A cap limits your credited interest to a maximum percentage. A participation rate credits you a percentage of the index gain without a hard cap. And a spread subtracts a set percentage from the index gain before crediting you the rest. In every case, a down index year means 0, not a loss. If you want to learn more, check out the free booklet called Retire Smart. It's linked on the page in the description box. If this type of video helps you plan for your retirement income, go ahead and like the video and subscribe to the channel. This is Retirement Securities Simplified, where we specialize in turning confusion into confidence, one conversation at a time.